Today, how low can Deutsche Bank go? Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Now, there are a number of global risks in the financial system. The trade war between the US and China, Brexit, China's slowing growth itself. But the one that really stands out is Deutsche Bank, whose share price continues to fall as the company wrestles with shrinking revenues, cost-cutting, and the prospect of reducing its investment banking arm following the collapse of merger talks with domestic rival Commerzbank. It closed at 6.46 euros, and the share price has dropped nearly 40% over the past year and is way down from 2010, when it was worth more than 40 euros. During the previous financial crisis, Deutsche Bank received $354 billion in revolving loans from the US Federal Reserve. Plus, according to a recent Financial Times piece, Germany's federal and state governments have spent around 70 billion euros since on bailing out banks since the financial crisis, including Deutsche. This, of course, cuts to the heart of the European Union. Now, on Monday, UBS downgraded its stock to a sell rating from neutral and cut its target price from 7.8 euros to 5.7 euros. Deutsche Bank trades at all-time lows and at a price-to-net asset multiple of 0.25, rarely seen in bank shares outside of insolvency situations. Deutsche Bank has been plagued by failed regulatory tests, ratings downgrades, big fines, and management reshuffles in recent years, and posted its first profit in 4 years in 2018. And it's also been linked to President Trump, and indeed Trump sued the bank last month to block its compliance with congressional subpoenas seeking access to its financial records. The investment bank's revenue is forecast to fall by 12.5 billion euros this year, according to consensus estimates, and that would mark a fourth consecutive year of decline, down 34% from 2015. The investment bank generates about half of Deutsche Bank's revenues, so it's also considered its Achilles heel, with European regulators fearful that it will fail the next round of stress tests in the United States. Deutsche could well be the source of wider financial stress, bearing in mind its large derivatives exposures at around $46 trillion, which extends into most of the major Wall Street banks, including JP Morgan Chase, Citigroup, Goldman Sachs, Morgan Stanley, and Bank of America, as well as other mega banks in Europe. According to data from the OCC to Q4 2018, which was released in March 2019, this puts the German giant behind JP Morgan Chase with derivatives worth $60.1 trillion, but ahead of Goldman Sachs at $33.9 trillion and Citibank at $42.6 trillion, all nominal. The IMF concluded that Deutsche Bank posed a greater threat to global financial stability than any other bank as a result of these interconnections. And that was when its market capitalization was tens of billions of dollars larger than it is today. A capital raising would likely be the next step to fund further cost-cutting, which they cannot currently afford to fund. But shrinking revenue against a high-cost base is the root cause issue here. And the derivatives risks extensive. This is one to watch, and frankly, for me, this is one of the most likely catalysts for a global financial meltdown. I'm Martin North from Digital Finance Analytics. Thanks for watching. I'll talk to you again next time.